So today we're going to begin our look at different asset classes. So, I'd mentioned we'd look at shares, currencies, bonds, and so on, and see what the main categories within each of those are. And then we can compare and contrast them. So we begin with shares. So we're breaking those into three types. There are growth stocks, dividend stocks, short stocks. So growth stocks would be shares which are growing, which you're buying primarily based on potential, based on the fact that you feel that in the coming 5, 10, maybe 20 years, this company is going to grow and grow and grow, and you're going to be on board. So you get to buy early when they're smaller, when they're basically cheaper. So as they grow, their earnings are going to grow, their value is going to grow, your investment's going to grow. Dividend stocks are typically more mature. So they're basically generating a steady income. And you, as a shareholder, get your cut. So as they bring in, their billions or millions, you get a certain percentage of that. And so they generate cash for you. So they'd be attractive for pensioners. If you've got those shares, when you retire, you'll get dividend as cash payment. And since the company should be increasing in value with inflation, your income should be increasing with inflation, which is particularly attractive if you've retired. Short stocks, well, I just put that in. I kind of think of, to me, short stocks are important. So if you have a particular, with a boom, there's a bust. So if there's a really hot area, and there's always a hot area, people are dreaming about the future. Their dreams typically are far bigger than reality can ever be. So the market prices based on that dream, based on the fact that this company is going to end up being bigger than any other company ever in history, because this company is incredible, but it hits the glass ceiling, it doesn't keep growing forever. So at some point that bubble bursts, everyone rushes to get out, the price collapses. So the reason that short selling is good is that you can make a lot of money far faster, because it gradually grows as more and more people jump on board, but when it bursts, it falls rapidly. So you might make 50, 60, 80% of the profit in value that you made as it went up in like a quarter of the time, half the time. And it's good to have a mix between long and short, so that you're not fully in a optimistic, dreamlike state. So that if you have longs and shorts, if the market collapses, yes, you'll be losing money on your longs, but you're actually winning on the shorts. So your portfolio is more well balanced. But we're just rushing through, giving a big picture of things, so time to move on. So what do I mean by growth stocks? Well, I said, company that's growing, a company whose market maybe it has a fantastic product. It could be a new invention, something that only they have, and actually everybody wants. So as more and more people buy it, suddenly this small company grows and grows and grows. It could even be a drug company that you discover a new medicine that cures an important big disease. Then that would be worth billions and billions, because everyone who has that illness will buy that drug because it's the leading drug. And to develop that drug requires vast sums of money, so lots of investor dollars. With that, they'll keep doing research and testing and blah 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 until hopefully that will result in something that works. And if it does work, well, then it's going to generate loads of money for the investors, and it's going to save loads of lives. Another example is Ryanair. So they saw an opportunity to introduce a no-frills airline within Europe, actually just kind of doing a variation of a business model that had been applied in America successfully already. There, the opportunity that they identified was that by offering far cheaper flights, they would grow their business, since who wants to pay more? And that has worked spectacularly well. Then you have, say, Apple, when they introduced, I suppose, the iPod. Of course, they'd also grown earlier with their PCs, but in the recent successful incarnation, they had the iPod, iTunes, which allowed people to buy music legally instead of downloading for free on Napster. Then with the knowledge they gained from the iPod, they did a little variation and got to the iPhone, and then they got to the iPhone, the iPad, and so on, resulting in them becoming the highest valued company probably ever. Then you have Facebook, growing very well indeed, managing to monetize their huge numbers of members, and who knows when that's going to stop. Then there are dividend stocks. So banks would traditionally pay a high dividend and typically be always increasing their dividend. They're very loath to cut. Oil firms like Exxon pay big dividends. Cigarette companies, utilities, so like electricity companies, they get regular, monthly payments of all their electricity bills, and so the shareholder gets a cut of that. With dividend companies, you're not promising spectacular growth, so you don't expect the share price to be increasing hitting new highs month by month. These are typically mature companies that are generating steady income. And so the way that they attract in investors is by promising them a steady dividend. And that's going to be index linked, because due to inflation, as the price of various things go up, their income goes up, and so your dividend goes up. Attractive to pensioners. Vodafone is an interesting company in that, is that a growth stock or a dividend stock? So the mobile phone was the next big thing, and then you were going to switch to 3G and have internet on your phone. This was going to be huge. But once everybody has it, as that market matures, it's more like a utility. It's more like it's generating steady monthly income from all the users of their phones. Of course, now they're trying to expand, with the quadruple play, so you can get your fixed line, your mobile, your internet, and everything with Vodafone, and try and bundle, pass on savings, and so on. Will that work? Will they beat the other companies who are also offering bundles? That's business. But I wouldn't say that Vodafone is really a growth company anymore, and it hasn't been for a good while. Likewise, Apple and Ryanair. So Apple has grown spectacularly, but recently they started to give dividends. Likewise, Ryanair. Ryanair has given dividends. Now, they've been special dividends, and the dividend rate isn't very high, but they've begun the transition. If you offer dividends, various funds are more likely to buy you. And so, as you want to broaden your appeal as a share, it's interesting to play around with dividend. Finally, there were the short stocks. For example, banks after a housing bubble. Now, to be fair, the banks tend to collapse before the housing bubble or bursts. It happens so quickly. So it's not, you don't get a long time during which the banks are in gradual decline. But they would be shares that you would like to have shorted if you got in at the right time. Oil companies at the moment, because oil went up to above $100. So all the business models adjusted their figures, assuming maybe even an $80 barrel world. But oil has collapsed even below 40. So loads of companies are now making losses. It costs them more to produce the oil than they can sell it for. So there's going to be a lot of pain there. I'd expect the big companies like Exxon to do well out of this, because they've deep pockets, and what they're going to do, or what I'd expect, is as there's a lot of pain out there, Exxon will snap up all the loads of smaller companies who don't have anywhere near as deep pockets as Exxon do. So then, once Exxon has taken over all the smaller firms, they can reduce the supply so that it matches the demand. The price will go up again. Now Exxon is a lot bigger, and again they'll make a lot of money because Exxon has lived through many oil price spikes and collapses, and they've fantastic management. I just wanted to close on the idea of life cycle, and then I'll just look at examples. So when you look at companies or industries, you have the early stage when they're tinkering around, seeing whether there's any business out there, whether they can find any customers, whether they can do anything that the customers want. Then the company starts to grow. They have a product, they have customers, they're making money, so then they can invest and grow. After a while, that growth peaks. All the people who want to have their product now have their product. So growth stops or reduces to a very low number. So then the earnings and the like enter a period during which it's flat. After which you have decline. There might be a new technological revolution. So the whole industry, the whole thing that you do becomes irrelevant. The world has moved on. So as a company, when you're in the mature phase, you want to be investing, you want to be trying out new growth, new early stage businesses, so that down the line you're not wholly dependent on your cash cow, on your currently successful product, because it's not going to remain successful forever. So we can see the life cycle notion, and if you just type in life cycle into Google and stuff, it's a well-known theory. So here we can see, the 4 basic stages. Introduction, when you're messing around trying to see whether you can come up with anything that works. Then when it clicks, you have the growth phase. So like I would say, Ryanair, once they got their early license to fly from Dublin to London, they started making money. They could identify the triggers, the things that the customers were interested in. So then they could concentrate on those and then try that same idea in different markets, which they were successfully able to do, and then they just repeat as they expand throughout the whole of the EU. So they would be, early, maybe midpoint of the growth phase. There's still a lot of room for growth, and they are showing signs of some maturity because they're now starting to pay some dividends. Maybe in 5-10 years they will have reached the peak of their current incarnation. Now they'll be thinking about, can I apply the same business model or a similar business model to maybe Asia? Can I do it in Africa? Can I do it in America? They'll be looking to see whether they can expand. Once they hit maturity, then they'll become a dividend company. They'll be generating steady income. They'll be selling out their planes. They'll have established a good model to be able to buy airplanes at a good rate, and it'll just be slow and steady until a more successful, innovative company knocks them off the perch. Facebook would be an earlier stage growth company, so they're still growing and growing and growing. That's what you expect from a growth company. Essentially, every year setting a record new level, just going higher and higher and higher, going from the bottom left to the top right. And here the investor is getting a lot of value just from the share price. They don't really need a dividend because they've doubled, and they're not showing signs that this is the peak. It could easily double and double again. In contrast, BAT is British American Tobacco, is a cigarette company which would be a dividend company. And if you look around, you see that the yield is 4%. The dividend is nearly 50 cent or 50 pence because it's pound. So yeah, you're getting paid over 4%. And as the value of the company increases, the income is giving you protection against inflation. So it's a good company to have in your pension fund. And you can see here, you know, the shit. Okay, this is too small. Maybe I would like, no, this is 2009, 10, 11. No, this is the last 5 days. I was trying to see what the time scale here was. So, you know, with a dividend company, you're not looking for, you don't need the share price to be doubling to make it worth your while to have invested. And finally, this is BHP Billington, massive mining resource company. So we've just had a huge commodities boom associated with the massive increase in demand from China. So this was a classic growth company. If you've been following the quant lessons, the quant side of things, this would be like, you know, the mean reversion. It shot up and up and up. Then 2000, you know, when the crash happened, 2007, 8-ish, BHP Billington were one of the first to massively fall. But it actually picked up again, actually getting to a higher level than it had that at that peak. It's recently fallen again. So commodity companies, you'll have huge demand, so the price will shoot up and they'll be making lots of money. So the supply shoots up until the supply ends up being far greater than the demand. So the price of the commodity collapses. Now loads of suppliers have to spend more money to produce the thing than it costs. So there's no opportunity for profit. All those companies go bankrupt. So the supply collapses and it starts all over again. So that's just an example of a boom type company. Facebook would be a company that's in the growth phase. The tobacco company would be a dividend company. Ryanair would be in the midst of transition. So it's still in growth. It's setting record high share prices. It's making record high money. And it should keep growing for at least the next 5-10 years. So it's not that clear cut. So that's our not so quick look at shares. Next we're going to look at 3 types of currencies.